and welcome to the FII View with me, Tanveer Gill. My guest today on the show is Mihir Worah, who's Co-CIO at PIMCO. He joins me in his first ever interaction with an Indian business channel, all the way from Newport Beach, California, the PIMCO headquarters. Mihir, great to have you on the show. Thanks very much for taking out the time.
Thanks, Tanveer. Glad to be here. And believe it or not, I think this is the first time I'm talking to Indian media.
We appreciate you joining us. In fact, let me begin by asking you, your view on the U.S. markets and the economy as such. With the recent rise in inflation in the U.S., is the risk of deflation off the table, you think? Do you think that this rise is sustainable with tapering running its full course?
Yeah, I think the risk of deflation in the United States is certainly off the table. We can, maybe later on we can talk about Europe, but in the US, the risk of deflation that people were worried about last year is off. I think inflation has risen sharply relative to expectations. So we did expect inflation to rise. The fact that it's been a little sharper relative to expectations is a few one-off factors. It's the big rise in energy prices that's since corrected post-Iraq. There's the rise in rents, which was expected. And in particular, last year with the budget and the sequestration and Obamacare, there were certain one-off factors that pushed down the cost of medical care. And that's coming back to more normal levels. So I think inflation is back. Inflation is going to be slowly moving towards the Fed target. And we're going to be range bound and have kind of a boring inflation outlook in the United States for the next 2 or 3 years, slowly moving up to the Fed's target, no deflation, not running away.
Fair enough. But with the Fed not committing to rate hikes soon, is that a reflection that while the Fed has contained the problem of a swollen balance sheet, it is still not confident about growth revival?
Correct. The Fed is still not confident about growth revival. Growth has been picking up in fits and starts, and it looks like the unemployment rate is coming down at partly because the participation rate is up. Fewer people are looking for jobs. So given how deep the crisis was, given what we know about balance sheet recessions or financial recessions, given the fact that inflation is still running below target, I think the Fed has room to be patient.
What about the Fed funds terminal rate projection being revised to 3.75% versus 4% earlier? Does it mean there is still uncertainty as far as potential of growth revival is concerned?
Correct. And this is where there's a lot of discussion at PIMCO. And this is where recently we coined the term the new neutral, which is a spin on our new normal that we coined about 5 years ago. And the point is, this new neutral directly relates to your question. Your question is, the Fed said the terminal Fed funds rate is 4%. They're slowly bringing it down. Now it's 3.75. We think it could be closer to 2. We think the terminal Fed funds rate is likely to be, or the neutral Fed funds rate is likely to be closer to 2%, somewhere between 2 and 3%. We call this the new neutral. I think the market's coming around to this point of view, which is why we've seen this aggressive rally in fixed income across the board, not just in the US, but in Europe and to some extent in the emerging markets too. So this is a key point. If the neutral real Fed funds rate is lower than what you thought, it's not 4, it's not 375, we think it's a lot lower. This is the risk-free rate that discounts every cash flow in the world, whether it's developed market stocks, whether it's developed market bonds, whether it's emerging market stocks and bonds. You start with the world's risk-free rate, which is the US Fed funds rate, and then you build in a spread and you build in equity risk premium. So if the world's risk-free rate is lower than what you thought it was going to be, this has implications. Bonds rally, stocks rally across the globe, and that's what we've been seeing this year.
What would then all of this mean for the dollar, as it hasn't shown as much strength as it was expected to at the start of the year?
That's a good point. The dollar, generally folks trade, the FX folks trade with a short-term focus, focusing on interest rate differentials, inflation, on a more short-term 1 to 2 year horizon, as opposed to terminal or 5 to 10-year horizon. So given the fact that amongst the developed markets, the US, not in 2014, but sometime soon, is likely to start raising interest rates slowly, while other countries, Europe, Japan, continue their easing, China to some degree. We do expect, while there's always individual names you can find, we do expect in general for the dollar to be stronger, not just versus the euro and the yen, but probably against certain emerging market currencies too. We haven't seen it yet, but we expect that to play out over the next couple of years.
Fair enough. Let's talk about Europe then. What do you make of the low inflation prints in the region? Do you think the market rally there is more a rebound from oversold levels and pricing in the expectation of a potential QE from the ECB?
Right. So inflation in Europe is certainly running very low, and part of it is a differentiation. When you look at European inflation, it's like looking at Asian inflation. There's many countries that unfortunately have the same monetary policy, that peg to the same monetary policy. So monetary policy might be too easy for Germany and too high for Spain. So part of that low European inflation is that inflation in the so-called peripheral or the Club Med countries is coming in pretty low. I do think as a result of this, the ECB with its quantitative easing, with its credit easing, the TLTRO, with the fact that they're going to keep rates lower for much longer than even the Fed, they're running negative deposit rates. All of this is an attempt to get inflation higher, just like the US Fed wants to get inflation higher. The ECB wants to get inflation higher. So what's led the European market rally? It's exactly what you said. It's these expectations of quantitative easing. Mind you, in the last couple of weeks, the European market has probably been one of the weakest performing global stock markets. It's been led down by the banking sector. There have been a few one-off names coming up in European banks, the situation in Portugal, the fines that BNP is paying to US regulators. Probably other European banks are likely to pay those fines. The fact that lower interest rates probably mean less profitability on their loans for banks. But all that aside, I think what the ECB is doing is going to help get inflation up. It's going to help grow the European economy, and the credit easing eventually, as one works through these bad news, is going to be positive for European banks. I think European banks are depressed. They're probably an attractive buy, and European stocks, with the correction that they've had over the last couple of weeks, are a hold as well. I wouldn't be aggressively adding to European stocks, but I'd definitely be looking at European banks here.
Then let's talk about India, and because we've also been grappling with the inflation situation in India for a while now. What do you make of the inflation risk in India? Much debated. Supply side issues are not helping food inflation, core inflation, even though the recent prints, of course, have been a bit encouraging. What do you forecast as the inflation trend?
Right. So there has been a cool off, whether you look at the CPI or the WPI, and I think that's fundamental. You will get, and India does need to mature its agricultural sector, so you don't get these bouts of inflation that are dependent on the weather. But you're getting reforms on the fiscal side, and obviously you've got a new central bank governor who is who's not going to make the same typical undisciplined emerging market mistakes of the past. So I think as far as inflation is concerned in India, I think it's on a much better trajectory than it's been any time in the last 10 years. Inflation's come down, and again, there could be weather-related spikes, but fundamentally, inflation in India over the next 10 years is going to average probably less than it averaged over the last 10 years.
In that light then, talking about the government benchmark bond, do you think at 8.5% yield, that's an attractive investment opportunity now that the expectation of a rate cut is perhaps back on the table with the latest inflation numbers?
I think Indian bonds are attractive from a fundamental credit perspective, from an inflation perspective. In fact, I think the government bond, the nominal government bond, is attractive to neutral. And the sector that I specialize in, those Indian inflation-linked bonds, I think are a screaming buy. Unfortunately, institutions like mine, the regulations are so onerous that we can't buy Indian bonds, but as much as we'd like. But if I could, I think those Indian inflation-linked bonds are a screaming buy.
Right, and talking about inflation index bonds, because while you find them very attractive in India, we haven't found many takers for that instrument. How does one look at hedging inflation risk then, and what's the opportunity that you see in the India dedicated inflation index bonds?
I think, again, I'm not the expert. I follow those for three reasons. One is I follow everything that goes on in global financial markets. B, my history is a deep specialization in inflation bonds, and C, I'm Indian, so I follow those. But they came at the wrong price when they were issued at a yield of inflation plus 1.5%. That was too rich. I wouldn't buy them even if I could. And so when things get placed at the wrong price, too rich, and then they sell off to correct prices, I think it burns and scars a lot of the original investors, and the whole asset class gets a bad name. Currently, they're trading at offering something like WPI inflation plus 4.5%. I think that's very attractive, and people who can get their hands on them should.
Among the big sectors then to invest in India, there's talk about an infra fund being set up. And the entire space, infrastructure debt, is highly underinvested. Do you find Indian infrastructure as a story very attractive to invest in? And what would perhaps get you to invest a lot more in the sector, given its potential going forward?
So two things on that. So the first one, I'll tell you that this is my personal point of view, because I generally, given the breadth of what I have to do, I generally focus on public markets and the liquid markets. So in infrastructure space, I think it's been the same thing. Very promising sector, but it's just been mismanaged in terms of inflation, in terms of policies. And so it's a promising sector that's been underinvested, and I think it's been scarred. Going forward, there's no reason why that shouldn't be attractive, but I'll caveat that with I haven't looked at it closely, and I'm not the expert on that sector.
Fair enough. Since we have you with us and you're talking about India, how can I not ask you about what you felt about the Indian budget? Do you think the government in its maiden budget pretty much delivered on expectations? What was your overall view?
Okay, so on the budget, I think the budget was. Some folks say they were a little bit disappointed in the budget. I don't think so, because I happen to be pretty patient both in my investing and personal life. I think it had some of the steps in the right direction. In particular, as it pertains, to the railway budget. So I don't think you need a big bang, flashy budget that can't be followed up, but I think it's a step in the right direction. And what's going to be important is to see that the budget is being implemented, and other reforms that are needed are also being steadily implemented. So I thought it was okay.
Let's talk about your overall view on emerging markets. And in one of your recent articles, you have stated that this is a good time to actually increase allocations to EMs, given the valuation gap between EMs and developed markets. What kind of upside do you expect from emerging markets then in the second half of this calendar year, over the next 6 months, that is?
I am seeing the trend pick up in that direction. Emerging markets, after lagging developed markets miserably in 2013, on average in 2014, they're slightly outpacing developed markets. Emerging markets as a whole are up about 6% in 2014. India is obviously up much more, close to 20%, but emerging markets are up close to 6%. And I think, the valuation gap has been around, and part of that valuation gap has been justified because earnings have been dropping in the emerging markets, and the growth differentials, the fact that the emerging markets used to grow so much faster than the developed markets, those growth differentials have come down too. And then obviously last year you were hit by really bad technicals with with the taper tantrum and expectations of an abrupt withdrawal of liquidity. I think all of those factors are turning around. Earnings, return on equity, and earnings revisions are moving up rather than moving down. The fears of a hard landing in China are turning out to be overblown. It is a slowdown, but you're getting some policy easing measures in China. The fears of an abrupt liquidity withdrawal, and in particular, what we call the new neutral, this expectation that the long-term real interest rates in the United States are actually going to be lower than what people expected. Like I said, turns around the technical picture or the liquidity picture that was hurting emerging markets, and I thought that the valuation gap, for a long-term investor, earlier this year was the time to start investing. And I think from what I hear, the emerging markets have been seeing steady foreign inflows, and I expect that to continue. As far as the rest of this year, emerging market equities are up, like I said, 5 to 6% in the first half of the year. I'd expect another 5 to 6% gains in the second half.
Well, India has been an exception to that rule, clearly, with the 20% year-to-date return. And that brings me to my next question, which is which are the specific markets where allocations could increase? And could India, given its run so far into the year, still be a candidate where there could be more money incrementally allocated?
I think you've got to be incrementally, given the long-term story on growth going up, inflation coming down, earnings generally, return on equity and earnings generally moving higher. I think as a long-term investor, you've got to slowly increase your allocation to India. But I agree. I mean, given the 20% rally year to date, you don't want to jump in right now, but it's definitely an attractive destination for long-term investors.
Then what would be your specific view on EM currencies? Actually, specifically, if you hold a view on the Indian rupee.
I think we're positive on the rupee. We've touched upon many of the reasons. It's the current account closing, the RBI being much more careful. They've been building up reserves over the last several months, smoothing out the volatility, so you get high carry, low volatility, a positive growth story. So definitely, positive on the rupee, positive on other high quality, high carry, low vol emerging market currencies like the BRL and the MXN, and generally, bearish on some of the European emerging markets like Hungary in particular.
I also wanted to ask you about, the risk of potential deflation coming in from China. The low inflation prints in China are raising hopes of more stimulus. What does that mean for the liquidity risk premium going forward as US QE will, it seems, get replaced by QE from Europe, China, and Japan?
Right. So I think we're in a sanguine period for liquidity. And for equities, like we said, emerging market equities, another 5 to 6%, developed market equities, less. But you're correct. The Bank of Japan, the ECB, the Bank of China are going to continue to pump liquidity in the markets. And the US Fed, while it tapers and it's going to stop buying bonds and stop pumping money into the market in October, its policy rate is still running loose monetary policy that's somewhat lower than the market needs in an effort to get inflation higher and the unemployment rate lower. So even though the US is going to stop explicit quantitative easing, it's still running easy monetary policy. So I think the liquidity conditions should persist for the rest of this year at least.
Fair enough. I also wanted to ask you, Mihir, given that PIMCO is the largest bond fund manager and that you really look at serious investments in that side of the market, why is there not more serious capital commitment made to the Indian benchmark bond, or in fact, for that matter, even some of the other bond instruments that are trading in India among emerging markets, given that India has no record of default and the rate of interest has also been rewarding on some of these instruments?
It's just hard to invest. The quotas are low, regulations, and for me to open an account to be able to buy bonds in India, it takes 3 months. This is we're one of the largest. We are the largest bond investor in the world, and it really takes a lot of time. It's very onerous to invest. If it was easier, then I think you'd see investment go up. But that's a policy decision. How much foreign money is required in the bond market? What should be the regulations? You want the long-term money, et cetera, et cetera. These are policy decisions that the Indian government and the RBI needs to make. But currently, it's just frankly, it's just and it's a small market, so it's not worth the hassle, frankly.
Fair enough. Then when is PIMCO setting up shop in India? Do you have some insight to that?
No comment, but when they do, I'll be the first to know. So.
All right, and we'll touch base with you then. I just want to wrap up with one final question, and that's your view on ratings in India. Do you think India can potentially become a candidate for an upgrade going forward in 12 to 18 months if policy action and macroeconomics, the variables there on growth and deficit are supportive? What's your view on India's ratings?
Yeah, I think being investment grade is a big deal for India, given the difficulties that India went through over the last couple of years. So it's the forward part that matters. But I think triple B is, I think that's appropriate. That's fine.
Fair enough, Mihir. We'll let you go at that. Thanks very much for speaking with us. Really appreciate your time today.
Thanks, Tanveer. It's a pleasure, and I hope I was able to shed some light on global markets and Indian markets.
Yes, indeed. Thanks again for joining us. With that, we come to the end of this edition of the FII View. Thanks very much for watching.